The U.S. crisis of credit, visualized and explained in 6 minutes. So, what is the credit crisis? Well, it's a worldwide financial mess involving terms you've probably heard like subprime mortgages, collateralized debt obligations, frozen credit markets, and credit default swaps. Who is affected? Everyone. How did it happen? Here's how. The credit crisis began by bringing together two groups of people, homeowners and investors. Homeowners represent their mortgages, and investors represent their money. These mortgages represent houses, and this money represents large institutions like pension funds, insurance companies, sovereign funds, mutual funds, etc. These two groups are brought together through the financial system, a bunch of banks and brokers, commonly known as Wall Street. While it may not seem like it, these banks on Wall Street are closely connected to these houses on Main Street. To understand how, let's start at the beginning. Years ago, the investors are sitting on their pile of money, looking for a good investment to turn it into more money. Traditionally, they go to the U.S. Federal Reserve, where they buy treasury bills, because that's the safest investment there is. But, in the wake of the dot-com bust and September 11th, the Federal Reserve Chairman Alan Greenspan lowers interest rates to only 1% to keep the economy strong. 1% is a very low return on investment, so the investors say, no thanks. On the flip side, this means U.S. banks on Wall Street can borrow from the Fed for only 1%. Add to that huge surpluses coming in from Japan, China, and the Middle East, and there's an abundance of cheap credit. This makes borrowing money easy for banks and causes them to go crazy with leverage. Basically, leverage is borrowing money to amplify the outcome of a deal. Here's how it works. In a normal deal, someone with $10,000 buys a box for $10,000. He then sells it to someone else for $11,000 for a $1,000 profit. That's a good deal. But, using leverage, someone with $10,000 would go borrow $990,000 more dollars. So he has $1 million in hand, mostly all borrowed. Then he goes and buys 100 boxes for his $1 million. And then he sells them to somebody else for $1,100,000. He then pays back his $990,000 loan, plus $10,000 in interest, leaving him with a $90,000 profit. This is how leverage turns good deals into great deals. And this is a major way banks make their money. So, Wall Street takes out a ton of credit, makes a bunch of good deals, grows tremendously, turns it into more money, and then pays it back. Now, remember our investors. They see this and they want a piece of the action. And this gives Wall Street an idea. They can connect these investors to these homeowners through their mortgages. Here's how it works. A family wants a house, so they save for a down payment and contact a mortgage broker. The mortgage broker hooks the family up with a mortgage lender, who gives them a mortgage loan. The broker gets a nice commission. The family buys a house and becomes homeowners. This is great for them because houses have been increasing in value practically forever. Everything works out very nicely. One day, the mortgage lender gets a call from an investment banker. He wants to buy the mortgage. The lender sells him the mortgage and makes a very nice fee. The investment banker then borrows money, millions of dollars, and buys a bunch more mortgages and puts them into a nice little box. This means that every month he gets a payment from the homeowners for every mortgage in the box. He then sticks his banker wizards on it to work their financial magic, which basically consists of cutting it into 3 slices and calling them safe, okay, and risky. They put the slices back in the box, and then they call it a collateralized debt obligation, or CDO. A CDO works like 3 cascading trays. As money comes in, it fills up the top tray first, then spills over to the second, and whatever is left into the third. The money comes from homeowners paying their mortgages. If some owners default, less money comes in and the bottom tray may not get filled, making it riskier. To compensate, the bottom slice receives a higher return on investment, while the top slices receive a lower, but still nice return. This is all done so that credit rating agencies will stamp the top slice as a safe AAA rated investment, which is the highest, safest rating there is. The OK slice is rated BBB, which is still pretty good, and they don't even bother to rate the bottom slice. Then, the investment banker sells the slices, the investors buy the safe slice, another banker buys the OK slice, and risk-taking hedge funds buy the risky slice. He then repays his loans. Finally, the investors have found an investment for their money, one much better than the 1% treasury bills. In fact, they're so pleased they want to buy more CDO slices. So the investment banker calls up the lender wanting more mortgages. The lender calls up the broker for more homeowners, but the broker can't find any more. Everyone that qualifies for a mortgage already has one. So they get an idea. Since the value of houses always goes up, if the homeowners are in trouble making their payments, they can actually borrow more money against the future value of their house. This is called a home equity line of credit, and they can use it to help pay their mortgage. And even if they still default, the bank gets the house that's rising in value. Since they're totally covered, they can start adding some risk to the new mortgages. And that's exactly what they did. They stopped requiring down payments, proof of income, or any documentation whatsoever. So, instead of lending to responsible homeowners, called prime mortgages, they started to get some that were maybe less responsible. These are subprime mortgages. And this is the turning point. So, just like always, the mortgage broker hooks up the family with a bank and a mortgage, making his commission. Sure enough, they take out a home equity line of credit, which is really taking out more debt to pay their debt. The lender sells the mortgage to the banker, who turns it into a CDO and sells it to the investors. This actually works out very nicely for everyone and makes a lot of people very rich. No one was worried because once they had sold the mortgage, they had no more risk. So, if the homeowner were to default, it would be the next guy's problem. As these mortgages became riskier and riskier, it was like playing hot potato with a time bomb. Not surprisingly, the homeowners default on their mortgage, which at this moment is owned by the banker. This means one of his monthly payments turns into a house. It's no big deal, he puts it up for sale. But more and more of his monthly payments turn into houses. Now, there are so many houses on the market that there's actually more supply than there is demand. And suddenly, houses aren't rising in value anymore. This creates an interesting problem for homeowners still paying their mortgages. As the houses in their neighborhood go up for sale, the value of their house goes down, and they start to wonder why they're paying back the $200,000 mortgage they borrowed to buy their house, when now it's only worth $50,000. They decide that it doesn't make sense to continue to pay their mortgage, even though they can afford to, so they walk away from their house. Default rates sweep the country and housing prices plummet. Now, the banker is basically holding onto a box full of worthless houses. He calls up his buddy the investor to sell his CDO, but the investor isn't stupid. He says no thanks. He knows that that stream of money isn't even a dribble anymore. The banker tries to sell to everyone, but nobody wants his bomb. He's freaking out because he borrowed millions of dollars to buy this bomb, and nobody wants to buy it from him. He can't get rid of it, and he's not the only one. The lender calls him up pushing his mortgage, but the banker won't buy it. The bank can't repay its loans, but it's in bigger trouble because of something called mark-to-market accounting. Mark-to-market accounting means that the bank's assets are worth exactly as much as the market is willing to pay for them. If no one wants to buy a CDO, it's worth $0, and a bank is worth only as much as its assets. This happens all the way across the financial system, and things start to look pretty dark. Boom! And then everyone starts going bankrupt. But it's more than it seems, and here's how it affects everyone. The investor gets on the phone, and he calls the homeowners, telling them, "Sorry, your retirement account just tanked." And now you can begin to see how the crisis flows in a cycle. This is what the credit crisis looks like, and this is where we are now.